A trading journal, often referred to as a trading diary, is a potent tool that offers a window into your daily journey as a day trader. It functions as a mirror, reflecting the details of all your trades, the trades you made, the trades you didn't, the actions you took, and the outcomes that they generated. This matters if you're trying to turn your trading into a full-time income. For starters, you must understand that this will be a difficult challenge, because one minute you're riding high on a win, and then on the next, you're feeling crushed by a loss. That is why you need a trading journal. The trading journal isn't solely about writing down the numbers. It is about sharpening your mind, honing your instincts, and making you a more disciplined and successful trader. Money Arata. A trading journal is about gaining control over your emotions, so you're not making hasty decisions driven by FOMO or panic. And the best part is that the trading journal is going to be like your personal roadmap to your consistent profits. It's going to be showing you what is working, what's not, and most importantly, why. With your trading patterns reflected back to you, now you will be able to make better decisions and avoid the same pitfalls. Now, attention, this is not financial advice. Read the full disclaimer before proceeding. Use a spreadsheet to improve organization and uniformity in your trading journal. I know that it's totally possible to do your trading journal just using pen and paper, but you need to invest time and learn how to use an app, a Google spreadsheet or Excel, that will give you more efficiency. So here's a detailed guide to set up a trading journal using a spreadsheet. The first thing you need to do is to set up columns for the basics, like the date, the asset or pair that you're trading, your position size, the entry and the exit price, and your profit and loss. Don't forget to also include the fees in your calculations. Now, add some columns to record your trading plan. We want to note what are your trading entry, your exit strategies, your stop loss levels, your target prices. Your risk management strategy is essential. Risk management, by the way, is one of the core skills that you will learn in Diamond Hands. Let me explain. For example, if you enter a trade at 5.15 with a plan to cut your losses at 5.05, this is something that has to be determined in advance, not when you start to see the red candles going down. When you are considering how much to risk on a trade, you have to always remember to protect your capital. Don't risk more than what you can afford to lose. Exposing yourself to the possibility of wiping up your account on a single trade can lead to stress-induced, irrational trading decisions. Maintain a cautious approach to mitigate your risk and promote rational, disciplined trading. And next up, log the market conditions. Keep track of the overall trend, the market volatility, and any key news or events that might affect your trade. Now, here's an important one. You have to add one column to write down your emotions before, during, and after each trade. This will help you to stay aware of how your feelings might be influencing your decisions. When you enter a trade, make sure that you have a solid reason for doing so. Set up a drop-down menu with your usual reasons. Each trader has different reasons to enter a trade, depending on the time frame that they're using. So why did you opt for this specific point? Were you influenced by volume, by volatility, maybe some catalyst? The why behind your decision-making can offer significant insights for future trades. If you can't find a reason on your list, it's a warning sign that you might be straying from your strategy. After each trade, take some time to review how things went. A trading journal is more than just a log of your trades. It is a tool to think better. So after the trade is closed, write an analysis. Did you stick to your plan? If not, why? What could have you done differently? What did you learn? This is where the real growth happens. If you thought about entering a trade but you didn't, also you can write it down. What was the reason you did not enter? Was it a good reason? Or did you let fear or doubt get in the way? You can create a separate spreadsheet to just log those that you didn't do. You can also add similar columns to your main trade log, but also include a column why you did not enter the trade. You are tracking here the missed opportunities. This can also give you some valuable insights. Find patterns among your losses. It could be the time of the day that you're trading, a particular sector that seems to be your weakness, or that when you're trading on your phone, you usually lose more money on average than when you're trading in front of your desktop. It is your duty as a trader to identify these patterns and create strategies to improve. Similarly, you can find patterns in your successful trades. You can make sure that you understand what strategies are working on your favor. Now, here's a pro tip. You can use conditional formatting to highlight your losing trades, so they're easier to be spotted and analyzed. By keeping a detailed journal like this, you will stay accountable, you can spot patterns, and you can continue to improve your trading game. A trading journal will help you to have more clarity and understanding of your own decision-making process and to improve it over time. So remember that the goal of the trading journal is not just to be keeping a record of your trades. It is a tool that will be helping you to learn. By adding these additional elements to your journal, you can start to gain a deeper understanding on your own trading psychology and also make more informed decisions in the future. A trading journal will help you to avoid the fear of missing out, also known as FOMO. FOMO can push even the most disciplined traders to make stupid mistakes. But that's where the power of a trading journal will come to play. It's going to be very helpful. See, when you are tempted to jump into a trade because of FOMO, remember that you need to open your trading journal to explain the reason why you're going to be risking your money. And on your drop-down menu, FOMO should not be an option. And you will be forced to make a more informed decision. As a professional trader, you want to avoid impulsive trades. By habitually recording and reviewing your trades, you can cultivate a disciplined approach to your trading. You're going to be prompted to be thinking about each trade more critically. Be asking yourself why you are entering that trade, what your strategy is, when do you plan to exit. Think of your trading journal as a wise mentor who's encouraging you to be planning and discouraging irrational decisions based on FOMO. This cultivates a mindset of intentional trading where each trade is a calculated move. In essence, a trading journal is more than a mere record of trades. It is a tool for cultivating discipline, combating FOMO and impulsive trades, and serving as your personal guide on the path to trading maturity. The real power of a trading journal is developing discipline in trading. Keeping a journal requires confronting the truth about your trading, both the triumph, the wins, and also your losses. This transparency nurtures a deeper understanding of your strengths and also pinpoints the areas that need improvement, directing your learning efforts in a more efficient way. Moreover, the practice of maintaining a trading journal will help you to have a heightened sense of accountability, responsibility. Each entry, each line, each row in your spreadsheet is a pledge to learn, pushing you to adhere to your trading strategy, to your trading plan. It will always be there reminding you that you need to have discipline. This is about making the right choices and also about taking responsibility for all your decisions, whether they're good or bad. You will be able to learn afterwards. Now, make sure to respect your journal. Don't neglect it. And other trading platforms and exchanges make it very easy for you to enter a trade with just a few taps on your phone. This creates a risk that you might neglect your own journal. You might be thinking, I'm going to be doing this trade later, I will be journaling. So here are 7 mistakes that you should avoid. Number 1 is the biggest mistake that traders make, simply not keeping a journal. Think about this. Trading is a business, and successful businesses track the performance. So without a journal, it's going to be very challenging for you to be identifying the patterns and improve your strategies and learn from your mistakes. Number 2, make sure to not have incomplete entries. An effective trading journal should not include just the facts of the trade, like the date, the asset, the price, but also your thought process. What are the market conditions? Is it bullish? Is it a bearish market? What are the emotions at the time? Leaving all of these important details can make it harder for you to later understand why a trade succeeded or failed. Number 3, many traders focus too much on the outcome of a trade, the profit or loss, and not enough on the process. The key to long-term trading success is consistently applying a proven strategy. Helping on the process will be helping you to be improving your strategy over time. Number 4, another common mistake is ignoring small trades. I know that some traders only journal their big trades. They're thinking that the smaller ones don't really matter. However, the small trades can add up, they can add and impact your portfolio significantly over time. They can also provide valuable insights into your trading habits and strategies. Number 5, not reviewing the journal. A trading journal is not just something that you just set and forget. It is essential to regularly review your journal to analyze your trades and look for patterns and areas of improvement. Number 6 is lack of honesty. Some traders tend to rationalize their bad trades and they kind of misrecord them in their journal. It is crucial for you to be brutally honest when you're maintaining a trading journal because self-deception can limit your progress in your growth. And finally, number 7, ignoring the emotional aspect. Trading is a highly emotional endeavor. Ignoring or downplaying the emotional aspect of your trading can lead to repeated mistakes. So it is very important to note your emotional state during each trade because this greatly influences your decisions. The consequences of these errors can be consistent losses, lack of improvement, repeating the same mistakes, and ultimately failure as a trader. So by avoiding these common mistakes, you can maximize the effectiveness of your trading journal and ultimately your trading performance. If you want a mathematical method to calculate and manage your risk so that your wins are bigger than your losses, then you can go to arata.se/diamond hands to have access to a special class. See, no one, not even the best traders, can predict market movements with 100% accuracy. Being a good trader is not about being right all the time, it's about being right more often than you're wrong. Managing your risk effectively when you are wrong. Hindsight bias is a tricky pitfall. We can see the episode number 66 of the Money Arata series, so you can take a look at more details. It is easy to convince yourself that you knew what was going to happen after the fact. Well, this can lead to overconfidence in your ability to predict future market movements, potentially leading to riskier bets and larger losses. To combat hindsight bias, it is crucial to document your trades, your reasons for making your trades, your expectations. So write down what you think will happen and why. And then, when the outcome is actually revealed, you can compare what happened to your initial predictions. This practice will help you to understand your own thinking, your biases better, and it can also help you to fine-tune your trading strategy. Remember, being humble and learning from your mistakes is key in your trading. The market can be a tough teacher, but if you're willing to learn, you can always improve. You can always manage your risk. You have to manage your risk. No single trade should have the potential to significantly harm your portfolio. A trading journal serves as a strategy compass. It allows you to examine your trading tactics and identify the ones that consistently bring you money. Trading without clear, measurable goals is like sailing without a compass. Your journal should reflect your trading goals and also track your progress towards achieving them. The good news is that you can have a step-by-step process with interactive activities teaching you exactly how to do all of that in our Diamond Hands training by visiting arata.se/diamond hands.